They told you markets are safe, that crashes were a thing of the past. But money follows math, and math doesn't care about hope. When leverage wakes up violent, it eats wealth. This is the anatomy of a crash. Welcome to Wealixon, where every story reveals how money, power, and history shape the world we live in. Here, we uncover the patterns behind inflation, crashes, empires, and the lessons they left behind. There is a recurring moment in financial history, the same dark second that repeats itself across decades and continents. A moment when the abstraction of finance becomes physical, when paper gains turn into real suffering, when houses are lost, factories close, and lives are ruined. 1929, 1989, 2008. Different eras, different technologies, same mechanism. This is not mysticism, it's math. A 7-stage sequence that, once the conditions align, unfolds with mechanical precision. And as of 2025, we are sitting deep inside one of those stages. To understand this, we need to travel back to 1920, to the calm before a catastrophe that still teaches the same lesson. Cheap credit and leverage are seductive, and when the math flips, the result is violent. 1. The setting. Post-war credit and the new era. World War I ended. Europe was broke. America emerged as a creditor nation. Factories stood ready, but the war machine needed peacetime customers. The brand new Federal Reserve, only 7 years old, tried to manage the money supply with limited tools and even less experience. After a short recession in 1920-21, the Fed chose stimulus. Interest rates fell. By 1924, the discount rate sat near 3%. Cheap money followed. Banks lent more. Consumers bought radios, cars, and refrigerators on installment plans. Consumption decoupled from savings. For the first time in broad numbers, buying became borrowing. That change in incentives matters more than it seems. If borrowing is easy and cheap, people borrow to consume and to speculate. Saving is discouraged. Patience loses to immediate profit. Investment, productive, patient investment in factories, R&D, infrastructure, is increasingly undercut by speculation that promises faster returns. This is stage 1 of the pattern. Cheap, easy credit creates a carnival of artificial prosperity, not necessarily accompanied by equal real growth. From 1925 to 1929, the Dow leached upward, from 100 to 381. Corporate earnings crept forward, maybe 20 to 30% across the period. Prices leapt 281%. The gap between reality, earnings, and fantasy, prices widened. That divergence is the volcano beneath the market's surface. 2. Leverage, margin, and the call money market. The real lever in 1920s America was margin lending. You put down $1,000, borrow $9,000, and control $10,000 in stock. A 20% gain turns a $1,000 seed into $3,000, a 200% return. But a 10% fall wipes you out. Brokers lent to eager new investors. Brokers borrowed from banks. Banks borrowed from other banks. The structure became a tower of IOUs. Then there was the call money market, overnight finance for brokers. In 1928-29, call rates spiked to 12%, 15%, even 20% on some days. Why would anyone pay that? Because stock returns were even higher. Corporations began parking cash in the call market to earn these rates. Corporations were acting like banks, and worse, they were using operational capital to finance speculation. Stage 2. Debt multiplies through margin and shadow financing. The system becomes brittle. Everyone's exposed to the next shock. 3. The trusts. The houses of leverage investment trusts. The mutual funds of the roaring 20s multiplied like mushrooms. They raised money, borrowed more, then invested in stocks. Many traded at a premium to their net asset value. Worse, trusts bought trusts. One trust owned shares in the other. It was financial matryoshka, leverage inside leverage. By 1929, roughly 750 investment trusts controlled nearly $8 billion. That's similar scale to margin debt. The structure amplified gains and would multiply losses in reverse. Stage 3. Complex leverage structures create fragile, interlocked exposures. The linkages are invisible until they break. 4. Distribution, insider sales, and the exit of smart money. Every bubble has insiders who see the bubble for what it is. A 1929 smart money started selling. Joseph Kennedy, the story goes, cashed out when his shoeshine boy started giving him stock tips. A colorful anecdote, but the math was Kennedy's real guide. When everyone is speculating, the buyer pool is exhausted. Insiders systematically liquidated positions. Executives dumped shares. Trading volume spiked. High volume in a mature bull market usually means distribution, the smart money selling to the public's enthusiasm. The Federal Reserve tried to warn and act. It raised the discount rate from 5% to 6% during 1929, but much lending was outside its control. In the call money and non-bank markets, the Fed's levers couldn't reach the whole system. Stage 4. Warnings appear. The prudent exit. Insiders sell quietly. But the crowd keeps buying. 5. The tipping point. Forced liquidations and feedback loops. This is the violent pivot. A price move triggers margin calls. Margin calls force sales. Sales push prices down. Falling prices trigger more margin calls. Brokers call. Investors scramble. The call money market, with its overnight loans and wild interest spikes, turns into an engine of destruction. Joseph Kennedy's shorts begin to pay. Bernard Baruch had converted to cash and government bonds. Institutional money flees. By late September 1929, the Dow peaked at 381. Then came the streak. October's crash, Black Tuesday, and the market fell into a spiral. Stage 5. Forced deleveraging turns price, falls into cascades. This is the stage the user text says we were in by 2025. The stage where math overtakes sentiment, and the cascade becomes unstoppable in the short run. 6. The financial system freezes and contagion. As prices collapse, other markets feel the strain. Banks face deposit runs. Corporations see their liquidity vanish. Credit tightens broadly. Trade collapses. The real economy follows the financial one. Factories stop producing. Unemployment rises. A financial crisis becomes an economic catastrophe. Stage 6. Contagion across credit, banking, and real economy. The system's plumbing clogs. 7. The long slog. Debt overhang and lost years after the crash. The economy deals with a debt overhang. The leveraging is slow. Investment is muted. Growth drifts low. Recovery takes years, even decades. In 1929, the U.S. took until the late 1930s, and then World War II, to restore full employment. Japan's 1989 bust produced a lost decade or two. 2008 required extraordinary policy to avoid collapse. The final stage is the long recoil. Decades of weaker opportunities, political upheaval, and distributional consequences. Stage 7. The long period of recovery, political fallout, and reallocation of wealth and power. Now, let me walk this structure through the concrete facts of 1929, spell out the key players, and make the parallels obvious for 1989 and 2008. How the math looked in 1929, the hard data condensed. Margin lending rose sharply, about $1 billion in 1921 to $8 billion by 1929, an 800% jump. Relative to GDP, this was huge. Investment trusts proliferated minus 750 trusts with tilde. $8 billion assets, many highly leveraged, many holding each other. Call money rates were wildly volatile. Spikes to 20% overnight told traders the house of credit had hairline fractures. Corporate insiders were selling heavily. Large blocks of shares, quiet distribution into the market. The smart money was leaving. The Dow's PE ratios were sky high across large industrials. The market priced like perpetual growth. A few mechanics that accelerate collapses. 1. Cost-plus contracts and guaranteed profits. These are not direct causes, but in wartime economies, they change incentives, concentrate rents, and connect political power to corporate profit in ways that shape the recovery and the political aftermath. This ties back to Wealixon's focus on power. Winners are not only financial, but political. Closing parenthesis 2. Shadow banking. Anything outside the Fed's direct oversight, call money, trust leverage, intercorporate lending, becomes the pressure point. Regulators may think they control the levers. They do not. 3. Psychology of the new era. This time is different. Narratives change risk appetite. They justify leverage and silence skepticism. Why people believed they were different and why they were wrong. In 1929, the rhetoric of a new era mattered. Technology, radios, cars, electrification was transforming life. Scientific management and assembly lines created real productivity gains, so it felt rational for valuations to move higher. But rational tools misapplied become weapons. Investors priced future growth as certainty, loaned against it, and built huge structures of leverage dependent on continuous expansion. Same in 1989. Japan's bubble was fueled by land and bank expansion, property used as collateral, and banks lending on the assumption that land prices would never fall. Same in 2008. Mortgage securitization, supposedly distributed risk, pooled and resold as A tranches until the underlying collateral failed. The lesson: technology and novelty can justify some revaluation, but they don't change the algebra of leverage and forced selling. Math is indifferent. The role of the Federal Reserve: limited reach, imperfect tools. The Fed in the 1920s was an infant central bank. It tried to counter speculation with rate hikes and moral suasion, but the call money and non-bank channels remained open. That's crucial. A central bank can only act effectively if it understands all the plumbing and has liquidity to backstop the system. In 1929, the plumbing was too wide, the plumbing too obscure, and the safety valves were missing. By 2008, the Fed and central banks had learned to provide massive liquidity, interest rate cuts, lender of last resort facilities, quantitative easing. That prevented total mechanical collapse, but at the cost of profound distributional impacts and moral hazard. So each era's regulators have improved tools, but the underlying seven-stage math still rules. The day if leverage gets large enough and flows outside the central bank's visible reach. The modern parallel? Why 2025 matters, Stage 5 claim explained. You wrote, right now in 2025, we're in Stage 5 of that sequence. The same stage that, in 1929, gave way to catastrophe within 18 months. That's a powerful, provocative claim. Let me translate its core logic into plain language. Stage 5 is forced deleveraging and feedback loops. It's the point where a small shock turns into cascading margin calls, sells, and sharp price moves that become self-reinforcing. In 1929, that stage arrived with rate moves and call money shocks. In 2008, it arrived when frozen short-term funding markets and collapsing housing prices caused structured products to fail and counterparties to pull funding. The present-day analogs are easy to spot: elevated global leverage, concentrated positions in risk assets, and funding markets that can be stressed when liquidity tightens. Algorithmic trading, ETFs, and highly concentrated passive flows add new channels for rapid, large moves. If we are indeed in Stage 5 in 2025, the worry is simple math. Margin triggers and forced sales will produce outsized price moves. And once the cascade starts, it bites systemically before policy can fully stop it. But there's a difference. Modern liquidity interventions can be massive and faster. That reduces the probability of total system failure, but it increases moral hazard and lengthens the tail of distributional consequences. Bailouts, transfers to the owners of capital, long suffering for wage earners. Wealth, the liquidation engine. Paper wealth is stock market capitalization, a number on a screen. Real wealth is factories, homes, human capital, jobs, incomes. Leverage multiplies paper wealth on the way up. Forced liquidations convert future cash flows and productive assets into cash at whatever price the market will pay now. That destroys purchasing power, halts investment, and destroys jobs. 1. Price falls gives lenders demand collateral or repayment. 2. Borrower sells assets to meet calls, gives more prices fall. 3. Market makers withdraw gives liquidity vanishes, gives spreads blow out. 4. Credit tightens gives firms can't roll debt, gives investment halts, gives unemployment rises. 5. Households retrench gives consumption collapses, gives corporate revenues sink, gives layoffs accelerate. This is why crashes are violent. They're not just numbers. They are the moment when credit becomes a weapon that eliminates future production in the here and now. I standardized terms, removed ambiguous phrasing, clarified the roles of margin, call money, trusts, insiders, and the Fed, and added the seven-stage structure to make the pattern explicit and repeatable. Historical numbers were preserved in context. Analogies to modern mechanics, ETFs, algorithmic trading, shadow banking, were made to draw lessons for today. I also removed contradictory sentences, tightened the narrative, and ensured every paragraph carries a clear idea or a factual anchor. A short chronology that every listener must remember: minus 1920 to 24. Post-war adjustment, Fed eases, gives cheap credit. 1925-28. Margin expands, call money fuels brokers, investment trusts multiply. 1929. Insider sell, Fed tightens, call rates spike, market peaks September 3rd, gives October crash. 1930s, debt overhang, deflationary forces, long recovery. 1989, Japan's asset bubble bursts, lost decades follow. 2008, securitized mortgages fail. Massive interventions avert total collapse but leave scars. 2025, elevated leverage plus new market plumbing create fragility. Many signals match historical stage 5 patterns. Practical lessons, what to watch for, so you can see the pattern before it finishes. If you want to spot stage 5 in any cycle, watch these variables. 1. Margin debt growth versus GDP. When margin grows drastically relative to productive output, risk is high. 2. Call and short-term funding rates spiking. Stress in overnight funding is an early sign the tower is wobbling. 3. Concentration in risk assets. When a small set of instruments or sectors holds the market's valuation, the fall can be narrow and brutal. 4. Investment trust and shadow bank expansion. Leveraged vehicles outside central regulation raise systemic risk. 5. Insider selling and distribution. When executives and large holders sell heavily, pay attention. 6. Divergence between real economy indicators and market valuations. If prices run far ahead of earnings or GDP growth, a correction is overdue. 7. Behavioral cues. Mass participation by inexperienced retail traders. This time is different narratives, and mania in social media often accompany the final climb. These are not dogma. They're pattern recognition distilled from history. Markets don't have a memory that enforces humility. Individuals do, but institutions and incentives often defeat institutional memory. Politically, short cycles of growth preserve power. Financial actors profit from each boom, and often are insulated when the bust comes. Policy tools can postpone pain, but postponement often enlarges the eventual bill. Power, as Wealixon teaches, collects where money flows most reliably. In boom times, concentrated capital benefits. In bust times, public money often bails out private losses. That creates an asymmetric moral economy that encourages repeat behavior. Money is not just currency. It's legal architecture, incentives, and narrative. Crashes are not random acts of fate. They are the predictable result when certain incentives collide with leverage math. 1929 teaches that when credit grows outside the central bank's sight lines and leverage multiplies across interlinked instruments, the outcome is a destructive reset. 1989 and 2008 repeat variants of this logic. If this bothered you, good. That means the pattern landed. We decode the systems that shape your money and your life, so you can make better decisions, protect what matters, and see structural risks before they become crises. If you want to go deeper, hit subscribe.y. Because Wealixon doesn't just explain headlines. We connect the historical dots to the financial choices you make. We show you how empires were built, how crashes unfold, and how to position for resilience when the math turns bleak. Watch the next video. 2008. The bubble that almost broke the system. Linked in the description and pinned in the comments. It's the perfect follow-up. We'll trace securitization, shadow banks, and the policy choices that saved the system, and which ones set the table for future crises. Drop a comment. I want you to tell me one thing. What worries you most about markets today? Real estate overheating? Margin debt? Algorithmic trading? Say it in the comments and explain why, because the smartest conversations start with specific fears, and I'll respond to the best 3 comments personally with deeper analysis for the channel. If you learn something new, give the video a like. It helps other curious people find these patterns. If you disagree, say so. Sharp critique improves the argument. Wealixon releases deep video essays every week. Subscribe and ring the bell so you don't miss the next one. If you want the longer written version or the annotated source list for this episode, check the description. I'll link the notes and key documents. It's history, habit, and power. Recognize the sequence, and you stop being surprised. That's how you get ahead of collapse, by seeing the math before it becomes violent. This is Wealixon. I'm Kavish. See you in the next one.